If you wanted to manage a financing business someday, or are now currently in the industry and wanted to manage a long-term funding sources effectively, well then this may be the perfect video for you. Let's talk about how derivatives work today. Hello there, it's Nina and welcome to our introduction to financing with derivative. So for this video, I'm going to actually show you, of course, what derivative is, how it works, why do they exist, and what is their purpose in the market. And then finally, we're going to talk about the different types of financial instruments that is used as a derivative. So let's get started. So what is derivative? Derivative is a financial instrument with a price derived from underlying asset. In a broad sense, it is an agreement between two or more parties. So what can be considered an asset? A lot of instruments. It could be stocks, bonds, currencies, market indexes, interest rates, or commodities. And these assets are called the underlying security, or underlying for short.
Still confused? To make things clearer, let's look closer. This is John. He owns a bicycle factory. To produce a new line of bicycles, he will need 5 tons of steel a year from now on. And this is Harry. He manufactures steel. He agrees to sell John 5 tons of steel at a certain price on a predetermined date in future. Thus, these two make a contract, or a derivative with steel as an underlying asset. Okay, but the question is, why not simply buy the steel when you need it? The answer is simple: to manage risk. Here is what John thinks. What if the price of steel skyrockets and I will lose money? And here is what Harry thinks. What if the price of steel falls and I will lose money? Each of them enters a derivative contract to manage risk, to agree on a price, and to protect himself from market fluctuations. Some traders use derivatives to speculate some price moves. In other words, they buy or sell asset with the expectation of making a profit.
Today, there is pretty much a financial derivative for everything, and many modern financial market innovations are based around the ideas of derivative. What began as a simple idea in a long-distant past were developed into standardized contracts and have now become complex contracts. The reason for this is that derivative is very good at meeting the needs of many different types of business and even individuals worldwide. So speaking of these complex contracts, I will give you the common types of derivatives that are often used in the business. And these are options, warrants, convertible securities, and rights offering. That will be discussed later on. So first on the list, we have option. In order for us to understand what options are, let's start with an example.
Meet Jane. Jane has a car. This is Bill. Bill requests from Jane to give him the right to buy the car from her at $15,000 in cash anytime during the next month. Jane might agree on the condition that Bill pays her 2% of the value of the car, which is $300, for waiting of a month without a transaction. Jane cannot sell the car to anyone else during this waiting period. Bill doesn't have to buy the car at this time frame, but he does have a right to do so. So let's look at the definition. An option is a contract allowing the recipient the right, but not the obligation, to transact a known transaction by yourself of a known asset and a known price in a known predefined time frame. A contract, the option agreement between two parties. A recipient of the option right. In our case, it is Bill, also called as the option buyer or the option holder. A known asset, the core of the option. In our case, it's Bill's opportunity to buy the car from Jane. At a known price, $15,000, also called as the strike, and $300, which is the price of the option. In a known predefined time frame. In our case, 1 month. After that time, the option has no value. This predefined time frame in which the option will be exercised calls the option's term or duration. Options that can be made exercisable at any time during the time period is called American option. Options that can be exercised only at the end of the period are called European. The person given the right in taking upon himself the obligation, in our case, Jane, is also called the originator or option writer or option seller. The technical name of an option that involves the right to buy an asset at a price is a call option. In our case, Jane sold a call option to Bill.
Options are very useful tools in business and are indeed used to help execute all sorts of transactions and help reach all sorts of business goals. Here are a few examples.
Sarah is a real estate entrepreneur. She meets Philip, the owner of some land close to the beach, who wants to sell his property. Sarah knows some friends who would love to buy luxury apartments in this location, which is a high-demand zone and characterized by a limited supply. Sarah approaches Philip and proposes a deal. The owner will award Sarah with the right, but not the obligation, to buy the land for $3 million anytime within the 24-month period. Within this time, Philip's property is off the market, and Sarah will have the time to proceed. Sarah has a high conviction on the project and pays Philip $50,000 for the option on the land. Sarah then prepares the plans and finds out she can build 30 condominiums. She approaches 10 friends and offers them to buy a condominium from her at $750,000. 8 agrees to the transaction and are willing to commit half the proceeds up front to secure the property. Sarah has now a sufficient capital to secure the deal and now exercises the option to buy the land. In this case, Philip sold a call option to Sarah. Margaret owns a coffee shop chain. One day, a competitor approaches her with a proposal to purchase 50% of her business. Margaret is happy to accept the cash offer and negotiate a $2 million company valuation. For some reason, the buyer doesn't want to buy the whole company, and Margaret worries the differences in business approaches and management styles might pose a problem. Jeff, Margaret's friend, comes up with an idea. The buyer will purchase half the business for $1 million, but will also grant Margaret the right but not the obligation to sell her full remaining stake in the business for $1 million. Based on the existing valuation times 50% remaining stake for a term of 5 years, if Margaret executes the option, the buyer must comply. The buyer awards Margaret the option and the deal is executed. The competitor buys 50% from Moonbox Coffee Shop. Margaret is $1 million richer. The new partner demands to improve profitability and takes drastic measures such as firing 2 critical high-cost employees. Profits promptly plummet, resulting in an operational loss. Margaret is devastated, but Jeff reminds her of her option to sell the remaining stake in the company, so Margaret promptly exercises the option to sell. The partner finds it to its dismay and can't back out from the deal, and must share out an additional $1 million to buy now a worthless loss-generating business. Margaret had the option to sell her share at the price they agreed to before. This option's technical name is a put option. Think of the option recipient, Margaret in our case, putting now the worthless remaining shares in her partner's hands and taking the money from his pocket. Now Margaret can take her dream vacation and sit margaritas with his friend Jeff.
From the given examples, we will be able to know now how and when we are going to use the call option and put option, where a call option is an option to buy an asset at a set price and a put option is an option to sell an asset at a set price. So now that we have the basic understanding of different types of options, let's now move on to option-related securities. First, we have convertible securities.
Convertible securities are fixed income securities that allows holder to convert the security into a specified number of shares of the issuing company's common stock. This can be formed as convertible bonds or convertible preferreds.
Why does a company issue a convertible bond, for example? Well, it gives them the opportunity to borrow money at a much lower interest rate. Because they're giving these bondholders the opportunity to benefit should the stock price go up. and the people are willing to pay for some of that upside by accepting of the lower interest rate.
A number of years ago, Amazon.com, when they were a relatively new company, issued convertible bonds. Why they do this? Well, as a young company, they would have had to pay very high interest rate because they were a risky company to bet. So by issuing convertible bond, they were able to borrow a low rate because people are willing to accept the upside that if the stock went up, they'd make some money off of that. So except that they accepted a much lower interest rate. So here are some terminologies. Conversion privilege gives you the condition under which the convertible security can be converted. Conversion period. This is a time period during which a convertible issue can be converted. We have a conversion ratio that tells the number of shares of common stock into which a convertible issue can be converted. And we have the conversion price that stated price per share at which common stock will be delivered to the investor in exchange for a convertible issue. This conversion ratio can be found by dividing the par value of the bond, typically $1,000, by the conversion price. For example, if the convertible bond has a conversion price of $25, the conversion ratio is 40:1. This means that a bond can be converted to common stock once the underlying stock price reaches $25. In this case, the convertible bondholder will receive 40 shares at the issuer's common stock. Keep in mind that a convertible bond is not entirely immune to volatility that may be experienced in the market in general or by its underlying stock, and rather may be more susceptible to this market risk than compared in a non-convertible bonds.
In addition to these securities that have an option features, we also have warrant.
A warrant, which is an option issued by a company to purchase shares of the company's common stock for a particular price during a specified period of time, often 10 or 15 years, though sometimes there is no expiration date. Warrants are generally issued as an incentive to investors to accept bonds or preferred stocks that will be paying a lower rate of interest or dividends that would otherwise be paid. When a warrant is issued, the exercise price is above the current market price. For example, a warrant on a stock currently trading at $15 per share might guarantee you the right to buy the stock at $30 per share within the next 10 years. If the price goes above $30, you can exercise or use your warrant to purchase the stock and either hold it in your portfolio or resell it at a profit. If the price of the stock falls over the life of the warrant, however, the warrant becomes worthless. Warrants are listed with a WT following the stock symbol and traded independently of the underlying stock. For example, if you own warrants to purchase a stock at $30 a share that is currently trading for $40 per share, your warrants would theoretically be worth a minimum of $10 a share or their intrinsic value.
In addition to the sale of new common stock underwriters, new equity capital can be raised using another option-based financing approach called a rights offering. So let's watch this short video from the Investors Trading Academy to further understand what is rights offering.
Welcome to the Investors Trading Academy talking glossary of financial terms and events. Our word of the day is rights offering. In a rights offering, also known as a subscription right, a company offers existing shareholders the opportunity to buy additional shares of company stock in proportion to the number they already own before any new shares are offered to the public. Such an offering is usually mandated by the corporate charter. To act on the offering, you turn over the rights you receive, typically one for each share of stock you own, and the money needed to make the purchase within the required period, often 2 to 4 weeks. The amount of money that's required is known as a subscription price. You don't have to buy the additional shares, and you can transfer your rights to someone else if you prefer. But buying helps you maintain the same percentage of ownership you had in the company before the new shares were issued, rather than having that percentage diluted. For example, a company whose stock is trading at $20 may announce a rights offering whereby its shareholders will be granted one right for each share held by them, with 4 rights required to buy each new share at a subscription price of $19. The company will also specify that the rights expire on a certain date, which is usually anywhere from 1 to 3 months from the date of announcement of the rights offering. Companies typically issue rights to give their existing shareholders the opportunity to buy additional shares before other buyers, and also to enable current shareholders to maintain their proportionate stake in the company.
I hope this video provided you a good solid foundation to understanding derivative and the types of derivative and how it works. So, thank you everyone for watching, and special mention to our Sir TJ. Sir, nasapod yung taon nagamong pang in English, ani sir, o niya, ang pamong pagka-vlogger in town. Masig na yung ma-discover, ani. Anya, sa mga classmates siya, magsinuportahan din ninyo guys. Tingagi sa pag-like o pag-hit sa subscribe sa YouTube na. And if you have comments, suggestions, exact reactions, ha? Feel free to give me your thoughts down below. Again, thank you and adios.